In this video, I'm going to talk about the adjusting entries. Specifically, I'm going to talk about accrued expenses. Just a refresher in case you didn't watch the previous lessons, adjusting entries are done at the end of the accounting cycle. For a lot of businesses, this means at year end. Some businesses do adjustments at month end. So you're going to see some variations out there. Adjusting entries would be to record revenues in the period earned, record expenses in the period incurred, and update asset and liability accounts. And these are some different types of adjustments that you might see. I've already covered deferrals. Now I'm going to cover the accrued expenses. And then in the next few videos, I'll talk about accrued revenues and depreciation. And probably once I get past that point, I'll make some practice worksheets and go over those in some videos. If you look up the definition of an accrual online, you might see something like this. It's an asset or liability that represents revenue or expenses that are receivable or payable. In other words, cash hasn't been exchanged yet, which creates either a receivable on the income side or a payable on the expense side. Or if it's easier to separate the two, you could look at these definitions. An accrued expense is when the business incurred the expense, but they haven't paid it yet. Accrued revenues would be when the business earned revenue, but they haven't received payment yet. So as I said, I'm going to focus on the expense adjustments. What would happen is at year end, the business would look through their records and they would look for any expenses that they've incurred, but they haven't paid yet. And they would want to make sure that these expenses are recorded. And some examples of some situations you might see are interest owed on loans, salaries owed to employees, and then any vendor bills for expenses that they've received but they haven't paid yet. And the adjustment itself is going to be, first of all, an expense, a debit to an expense account to show that they've incurred the expense, and then a credit to a liability account to show that they owe that money to someone. I'm going to walk through two examples to demonstrate this concept. The first example is a situation where the company purchased equipment with a one-year note of $6,000. The interest rate is 4%. I tried to keep this example as simple as possible so that I could explain the concept. Basically, what they're doing is they're borrowing $6,000 to purchase equipment, and they're going to pay that $6,000 back a year later, and they're going to pay the interest a year later. So first you would have a journal entry for the purchase, which would be a debit to equipment, credit to note payable. And that was on December 1st. Well, if they have year end on December 31st, they owe interest at that point. If they borrow money, they might not have to pay that interest till next year, but they owe the interest up to this point. In other words, they owe interest for the December 1st through the December 31st time period, because you technically owe interest every day that it's outstanding. You would use a formula to calculate the interest, which is principal times rate times time. So if I plug the numbers in, I would get $6,000 times 4%. And the time, interest rates a lot of times are stated in annual rates. So you want to break that down into what it is per month. So you're looking at 1 out of the 12 months of the year. In your calculator, you can just do 6,000 times 4% times 1 divided by 12. If 2 or 3 months had passed, you could do times 2 over 12 or times 3 over 12. So just put in the number of months that have passed divided by 12 because there's 12 months in a year. The calculation for this is going to be $20 for 1 month. So they are going to have an adjusting entry to accrue interest expense for that 1 month that has gone by since they borrowed the money to year end when they're doing their adjustments. And this is what the entry would look like. They would have a debit to interest expense to show that they've incurred this interest expense. And then they would have a credit to interest payable to show that they owe the interest. They haven't paid it yet. They're not going to pay it until next year. I'm going to go ahead and do a second example. In the second example, this is going to be related to salaries expense. In this example, employees are normally paid on Friday, and we're going to assume a 5-day work week, Monday through Friday work week. They get paid on Friday, and salaries are $5,000 for the week. Well, in 2024, December 31st fell on a Tuesday. So let me just pull up a calendar. Okay, I have the calendar pulled up, and I'm going to go back to December 2024. You can see on this calendar that December 31st, 2024 was on a Tuesday. If salaries are normally paid on Friday, then they would make that entry on Friday normally, and that entire salary expense for the whole week would be put in 2025 because this is 2025. However, the employees worked in 2024 and 2025, and the company incurs the salary expense every day of the week. So if it's $5,000 for the entire week for 5 days, that breaks down to $1,000 per day. So technically, the company had salaries expense on the 30th and 31st of 2024 of 2 days, and then first, second, and third, 3 days in 2025. So basically, the adjustment is to split the expense between 2024 and 2025. So like I said, there would be an adjusting entry to accrue salaries expense for those 2 out of the 5 days for Monday and Tuesday. This would be in 2024. You would debit salaries expense for $2,000, which is just $5,000 times 2 days divided by 5. Or you could do 5,000 divided by 5 days, which is $1,000 per day, times 2 days. However you want to put it in your calculator, you should get the same result. So you're debiting salaries expense for $2,000, which represents the Monday and Tuesday that the employees worked, and you would credit salaries payable for the $2,000 to show that this has not been paid yet. It will be paid in 2025. And then in the following year, when the salaries are actually paid, there would be an entry to reverse that salaries payable. You don't want to have a payable on your books if it's something that has been paid. So on January 3rd, 2025, you would have an entry like this. You would reverse the salaries payable to zero that out. In other words, this credit would be offset by this debit, and that balance would zero out once the employees are paid. And you would debit salaries expense for the $3,000 for Wednesday, Thursday, Friday that the employees worked in 2025. And then checking would be a credit for the total that was actually paid. Now, I know in real life you would have payroll tax expense and tax withholdings and all of that, but I was trying to keep this example simple just to demonstrate the concept. And you'll notice that the total salaries expense between the two entries adds up to $5,000 because the company incurred salaries expense of $5,000. All I did here was divide it into 2 different years. And that's all I wanted to cover today. If you have any questions, feel free to comment below, and I'll see you in the next lesson.